Hello, everyone. Let's have a good week. Who's with me? Hello, Mandy. Nice to meet you. Ingmar and Richard and Steve. How are you? AJ. Everyone doing okay? So I'm not sure if the Ryan and K-Man are going to be with us today.
I do not believe they will be with us today.
Yeah,
and
I know
good morning.
they did. Good morning, Blake. I know I saw that they did not do the flow show, and they better learn to notify our team when that's going to happen.
Yeah.
What do you think? Huh?
Yeah. You know, it's new for them. You know, they're wrapping their.
You
their
are
heads
the
around.
most patient guy I've ever met in my whole life. I tell you, you'd have to be to work with me for 6 years, Blake. Anyway, congratulations.
Thanks, I've made it.
Yeah. So I'm glad you're here.
I'm here like, too. Good morning.
Good morning,
yeah,
Stel.
that's right, Stel. So guys, I don't know. I don't feel like compelled to, build a position until like after Wednesday afternoon during the presser or something.
Well, we were just chatting in the chat room, how Benedict had just brought it up, how the markets have really almost given back everything that whatever we saw was made on Friday, whether it was gold bouncing back, the dollar pulling back, everything has recovered since Friday. And I think, it's a big deal. I mean, you gotta, I'm not going to be aggressively trading between now and Wednesday.
Yeah.
And it's something I said in the week ahead video. I think that this week is parsed out into two parts. It's before the FOMC and after the FOMC. That's it, right?
Yeah, right.
So, that's
so just scalp around if you do anything,
What's that? Just
scalp around the market.
Yeah, I mean, you just don't want to get too aggressive with the market right at this stage. And I am all about like trying to position myself in the market, but I haven't really come up with a plan of attack exactly where I want to try to enter ahead of the markets. I mean, Stel, what do you think is going to happen? What do you and Dale, what do you guys think is going to happen this Wednesday? What's the Fed going to do?
Well, that's a good question, because the market thinks there's a good chance, a decent chance, let's say 20% or something like that, of 100.
Cool. Yeah.
Which I find it difficult to see happening. Obviously, anything can happen, but I don't see that. But I'm with you. I am not going to do anything major. I might not do anything at all until Wednesday. And especially since we're seeing this, seesaw action, the dollar losing ground on Friday, like you said, gaining it back today. Yields are on the verge of a breakout. So 10-year US is at 350. There you go. Yeah. It's practically touching, almost the new highs now. So it's a tough call, and I really don't have a view here ahead of the FOMC. I mean, if you put a kebab skewer to my head, I say they're going to do 75, and the dollar is going to probably retreat a little bit after the FOMC, but I don't know.
Well, Dale, I was just going to say, you're bringing in like the best guest today, Eric Bosmajian.
I discovered him.
Huh?
I discovered him.
You did, and he's awesome. I love, and actually I spoke with him last week.
And now he's more famous than us. How does that happen?
My God, like 100 times over. Yeah. But he's great, and he's a perfect guy to talk to today. And like I said, I met with him last week, but we talked real estate. Like we talked about the real estate market, and that we did talk about rates and stuff, but this will be a really good interview today. So I think you're, great choice selection on a day like today. So
that was just coincidence.
I'm telling you, it was very pro.
It worked out. The only thing that I noticed is with the yields doing what they're doing still, it usually was the other way around. It seemed like the yen was leading yields for quite some time, and yields were kind of lagging through this period. And one thing I think I would take a stab at some type of stop hunt if that happened after the Fed above these highs, because it'd be the first time that the daily won't confirm, even if it doesn't. Now, if it's sustained above those highs, then, then it's a breakout. That's a different story. But I'm thinking there might be something to do there, at least for short term. And the 4-hour, I doubt, would make, would confirm. And, maybe it doesn't even get there. So I think the tone has shifted. They say never sell a sleeping market. I mean, feels to me like the yen is, taking a nap
It does, yeah.
last week, quiet before the storm or something.
It definitely is. I
Feel that way?
I 100% agree with that.
Yeah. So, gold still, I'm seeing, I know Greg is looking for 1600.
Yep.
I've seen some wave targets in the 1630s.
Yeah,
as
it
well.
could well happen. I still have half my short stop
It
at break
wasn't
even.
easy, but I'll tell you, it sure made it. You sure know now what an important area it is if you didn't know it, and that's why you did the breakdown.
Yeah.
So I mean, if you want to be bullish gold, instead of trying to pick bottoms, just wait for it to trade back above 1680.
Well, I think that's exactly the way you have to trade it this week. Stephen was just saying
It's
I'm
too
still
safe to do that for my personality.
No, I agree. Stephen was just saying, hey, I'm short and I'm glad it's come back down. I mean, it's holding the breakdown point. So you can't be
Twice,
bullish until it gets
3
back
times.
above, like you
Yeah.
said, 1680 or 1700.
Yeah.
I mean, there's just no reason to be. But the sentiment is so bearish right now on gold. That
11.
is, I think, the big risk.
Yeah.
Right.
Yeah. Yeah.
I mean,
And the only thing I could say that's positive compared to like the gold is that since the CPI, with all the risk off we had last week, I'm not saying that it won't finally capitulate, but Euro's held. I mean, everything else took out the low from that CPI that we had, and so far the Euro hasn't. Gold did. S&P's big risk off last week. Aussie took it hard, but I don't know. Maybe the Vatican is buying euros. Very unusual story for Pope Francis to put out an edict and then make it public that they're repatriating all their assets back to the Vatican Bank.
wait, I didn't catch that this weekend. Is that
Yeah.
something I missed?
It was in a Catholic magazine that the Pope put out an edict that the church had 30 days to bring all the assets, including gold, back to the Vatican Bank.
Does that include all black money, drug income, and everything else?
All right, we're not gonna, we're just, I'm looking at this as a, just a financial thing, Steve, not the history of the church. Okay.
Yeah.
Okay,
So,
I was just wondering out loud.
Yeah, well, you know what someone told me once? You don't have to say everything you think. You ever hear that one? You
Yeah,
like that, Blake?
but
Anyway, write it down.
completely incapable of implementing it.
Yeah, I don't believe it. It's a choice. So anyway, I think that's kind of, they know something. Are they worried about their assets being in European banks right now? It's just something interesting. And I don't
know.
like the fact, I don't like the fact that Biden came out, I talked about it, the nightmare that desperate men do desperate things, and Putin losing on the battlefield, and what Kissinger said about him, that he'll escalate to de-escalate. And then Biden comes out and says, there'll be grave consequences if they use a tactical nuke. And I don't like them coming out. I know this is a little political. It almost makes it like don't invade Ukraine, so anyway, there's some heavy shit going on out there, Blake.
Oh no, I believe there is. Actually, I've been the meeting between Putin and Xi
Yeah.
last week, that's scary,
Yeah.
It's scary because it seems like that you're basically Putin's given Xi the green light to, hey, go take Taiwan. I've got your back, type of thing. And that it's going to get pretty active, if not already. And I don't like to say that, as I've got teenagers right now that are of age, for a draft. It's not something that I'm particularly looking forward to experiencing real time what a major conflict is going to look like. I just don't want to see that. I mean, no one does anyway. And I actually think most people like myself that are actually combat veterans that have been in war, we are more apprehensive about it. It's people that never experience like kind of what it's like to be in a war-torn environment or country tend to be the ones that are more gung-ho. And and then on top of that, I got like family, half of my family is in Taiwan. So yeah, it's a scary situation. So
the last thing, and then we could talk about happy things, is Steve, how about do you guys have any thoughts, or have you ever thought about the directive that President Biden, the executive order that he signed to move forward on the CBDC for us, a digital currency for us?
No, I didn't see anything on that.
Well, okay, that's all.
I've never figured out the value of any of that.
Of what?
What do you mean value? For the government, it's huge value.
Of course, but I mean of having even a debate about it. They're going to do it, right? We know that. It's a matter of when, it's not a matter of if. Because in general, as we've said multiple times, what they want to have is they want to have all the money under the control of monetary policy. And
like China.
Tax it as well, right? And be able to tax.
And also have full control at the flick of a switch. They control who has access to his to his funds, to all that.
Exactly.
To traveling, to everything.
Everything.
Exactly.
Everything.
So I think that's the biggest financial story since the gold window closed.
Yeah, but I think it's nowadays more or less an old story. I mean, it's going to happen. End of story. I mean,
you may be aware of it, but I don't think that a lot of that the mass population has any idea what the implications of abuse of power.
Unfortunately, mass population doesn't have an idea about most things.
Yeah. Well, I'm one of them. All right. So, I'm just talking about these things because they are in the backdrop, and sometimes it's good to be a little bit more macro when there's not that much micro to do, and kind of gives you a narrative. So, in this environment, go ahead, Blake.
No, but what I actually think we should be discussing like right now is we should be discussing, the strength of the dollar as we head into the Fed. Since Steve, you're here too, I'm going to ask you, do you think the Fed's going to go 0.75%, or do you think they're going to go a full percentage point?
I have no idea. And in the grand scheme of things, I consider it kind of irrelevant as well. I've answered to equivalent questions 100 times. For me, it's not so important if they're going to do 75 or 100. Yes, I do understand short term that's going to move the market. 100 basis points is really, really going to spook the markets. So if I was a betting man, and I don't consider myself a betting man, I don't consider what we're doing like, casino betting, I would assume that they would probably refrain from going 100. It's unnecessary in the sense that they can keep raising 75, right? And it's just going to take them like a little bit longer without really, really spooking the markets. So if I was a betting man, I would say 75. But in the grand scheme of things, I don't think it really matters. What matters the most is what is the level they're willing to reach in interest rates. That's the most important part.
And that's this chart right here. Chris Weston brought together the calculation for, the terminal rate, and this is what the market's pricing in right now is the terminal rate to reach 4.5% eventually. That's what the market's pricing in. So this is going to be the chart that
although
really
as you see in that chart, Blake, it has been readjusting itself multiple times, right? It has been climbing higher. So the fact that the market is currently believing that the terminal rate is 4.5% doesn't necessarily mean that that's going to be the case, right?
No, but that's what the market is pricing in.
Yeah.
So
at the moment, that's what it prices in. And
So
obviously,
correct.
if we get 100 basis points, I'm pretty sure that this same chart is going to be repriced immediately, perhaps towards 5%.
It could be, and this is the point that I made during the week ahead video. You got to watch if we again, could be a situation where the Fed front loads everything. So you get this full percentage point rate hike because the inflation print it spooked the Fed. The Fed's like, look, we're gonna nip that in the bud right now, and then from there they might not be so aggressive. Then you might see the terminal rate actually come down following a hike like that, and that's where you get the oh my god, that was a dovish hike. You know what I mean? So it's going to be a really interesting Fed meeting, I think, this week. And it's going to be a market mover. Let's all, acknowledge the fact that gold continues to break down and we are in breakdown territory. I mean, here's the gold chart. And as long as we remain below, as Dale pointed out earlier, and I think is, very, very critical, as long as we remain below 1680, you have to be bearish gold, or at least if you're not short gold, understand that it is in breakdown territory, and that is going to have a bullish effect on the dollar, at this time. But if gold really starts to reverse, that's when we, may see the dollar weaken. And, one of the other things, being in the euro, or not being in the euro, I mean, looking at the euro, one thing about the euro is it really has found some pretty solid support down here. I'm surprised the euro is not trading lower.
With risk off, Blake, last week and everything.
Yeah.
So yields.
Yeah.
It held the CPI low. The low of the week was made on the CPI.
Right.
Anyway.
I mean,
we did get one of the ECB members. Who was it? I can never recall their names. Who was talking about having to raise rates by a lot more. Quite hawkish talk. And I'll find out the tweet and tell you who it was. But it was one of these members being particularly hawkish, and you have to think that at some point this big policy divergence is going to narrow quite a bit. I know the ECB already started hiking, but they're way behind, and this is going to be I think it's going to narrow, and maybe the market's afraid of that, or the market is just waiting for Wednesday before either letting the euro completely crash or
and
bouncing.
I think that's probably right, Stel, is you're gonna the market's gonna wait till Wednesday, before trying to be directional. But a couple things I want to point out regarding the dollar. You do have the euro that's down here, and it's hovering around parity, and it's seeing both sides of parity by 50 pips roughly. So we got about 100 pip trading range right now, just in between the two. And but look at the sterling. The sterling is at major channel support, and this is also 161% extension of this last move. I mean, we're consolidating below it, but it's a big deal, being down where we're
glaring
at.
Divergence, Blake.
Oh, huge. I mean, I have it drawn right here. Huge divergence. And
you need your cursor to see that.
Yeah, no, it's very, very obvious. But does that mean that you should be buying the sterling right now?
Means you shouldn't be short, at least.
Means there you go. You got to be really careful being on the short side. I just don't know if it's the right time to be long just yet. But I wouldn't want to be short down here. Yeah, I just wouldn't. It's not that definitely is not my cup of tea. But the Aussie, the Aussie continues to drop. I can't. I think it was Benedict in our chat room. He's like, yeah, look at the hammer on the Kiwi on Friday and look at the price action today. I mean, we've just given all of that back. You know, there were a lot of reversals on Friday that have just, you know, completely, you know, reversed again on, you know, coming into Monday. So, and I'm not sure if it's a product of just lack of liquidity. I mean, you don't have, you know, and most of the people in the UK are not here right now. So, you know, everybody is mourning the Queen, and you know, the recession is happening right now. I was actually just watching some of it on BBC just a little bit ago. But that's, you know, just lack of liquidity here. You know, take a look at the Swissy. You know, the Swissy is like had a nice recovery, but you know, we're just kind of consolidating. One of the scarier ones here is the dollar Canadian that continues to break out. You know, this is a big breakout, but we're also coming into channel resistance, big channel resistance, in my opinion. So you can see it right through here. I wouldn't care so much about this because of the false break here, but as you can see, the lower you know, trend line I think is pretty significant. So
Yeah, nice look.
Yeah, it looks like we're going to reach for 134. You know, we're almost there. So anyway, let's talk a little bit of equities and talk about the stock market. I mean, we broke some major support, and we're below that 3,900. And here's, you know, a AB equals CD target comes in around 3,700, and it looks like stocks are heading down there. I mean, what the only thing that's going to turn the stock market from here is on Wednesday. Like if we get some indication from the Fed that you know, they are seeing, you know, they've raised rates to a point where they think they can, you know, slow the pace of rate hikes. That's the only thing that would allow for some sort of recovery in the S&P. Can you see any other reason to buy stocks?
Not really. Not unless yields or the dollar just turn around completely. But why would they turn around? For the reason you said. So I don't see any other scenario at the moment. No.
Yeah, I mean, I don't see any reason to be buying or being long equities. Steve, how about you?
No, I think you know my opinion.
Yeah, right. But you know, the stock market at the same time, you know, you obviously want to sell rallies, and the rally that was that happened, and the ones that have happened up and, you know, get anywhere near the 200-day moving average have been sold, rightfully so. But I guess the question is, are we going to be able to make new lows on the year and close out the year? Remember, we started the year at the highs. So, you know, if you take the where we're at right now, the stock market is down, and this is just the S&P obviously is down 20% on the year. Are we going to be able to close out the year, you know, down 25% on the year, or is there going to be some sort of recovery going into the fall? So, and again, what could provoke that? And the only thing that I could see is just a shift in the Fed, not so much a pivot, but more of a just not so hawkish, right? So anyway.
Yeah, we shouldn't be fighting the Fed. The Fed is once again dictating risk assets. The end of story.
Right,
you know?
Right. They are. So, you know, I guess I'll ask this of you, Stel. If you're going to have the stock markets that's so weak, and you've got, you know, precious metals that are breaking down, what's going to turn the tide on precious metals? Like, I know you know, you want to be long silver, but when gold's breaking down, can you be long silver? Can you be bullish silver? What do you think?
No, of course not. If gold breaks down and this move sticks, then I think silver is going to go with it. This temporary divergence, I don't think it can hold. It's never really held in the past for any meaningful period of time. So if that happens to gold, I think silver goes as well. That's why I'm waiting for it. So yeah. Well, I don't know. So. I don't know.
Yeah, I mean, how low can gold go? And the thing that really worries me the most about gold right now is it is so the sentiment is so poor on it. I mean, if you look at the DSI readings, I'd have to go back and check what it was Friday. I believe it was at 12, but let me see. Let me go back.
It's the flip side of what you came out talking about from your last trader summit, where everyone was bullish gold. I remember you talking about it.
Yeah.
There wasn't anyone that wasn't bullish gold during that conference.
Yeah. And
Remember?
now everybody is bearish gold, right?
Right.
And
you're going to have
CFTC
another
position.
conference.
Yeah, and we are going to have another
a lot
conference.
of coincidences.
That is a great point. It's a great point. Very, very true. Well, here we are at gold DSI. I was just looking, was as low as 7 last week on Thursday. We got a bounce back on Friday. As a result, it's down to 12 right now.
Yeah. So
we got a little bit of that recovery, pulled that bearish sentiment up a little bit, to not so extreme, but it still is extreme. For me, if it's below 20, especially below 15, it's pretty extreme. And that's what we've got right now. But I think you got a
relic.
What's that?
It's an archaic relic.
It's a barbarous relic.
Barbarous.
Yes. There you go. Get the lingo right.
Speaking of
it's a paperweight.
Speaking of digital relics, look at Bitcoin.
Good segue, man.
Yeah, I mean, Bitcoin is now. You could actually argue here. This is a bear flag pattern. We didn't complete it. And then we rejected the 618, came back down, and we just hit a fresh low, completed the flag pattern. And do you sell it here? I mean,
wild trading.
Yeah, I mean, it's you look at Bitcoin. I mean, I wouldn't want to be bullish, but Ethereum just completed its merge. We're here at the 618. We're also previous breakout point. This is previous resistance, current support.
Yeah.
It's hard to be bearish down here after the moves that we've seen, but then again, it's like I don't think that gives us any reason to be bullish either. So anyway, just some thoughts about that. Oh, a big breakout that's happening right now is the euro sterling. Look at this bad boy.
Yeah.
Oh, who's been talking about that one for a while?
I mean, hey, you guys are all just very, very much. Well, I know Ryan was shorting it up against these highs, and once it broke through those highs, he didn't want to be short anymore. I think he stopped and reversed. But I mean, look, Stel, we're breaking out here. Where do you think the euro sterling goes?
90. Said it before. I think we go to 90. At 90, we make a big decision, and probably that's the time to start to get bullish the pound again. But not yet. I still see very, very few, if any, reasons to be bullish the pound. The end.
Yeah. Okay. Well, we do have this week. We have the Bank of England.
Yes.
Following up behind. The Fed, and we also have the Swiss National Bank. So, the Bank of England,
the Bank of Japan as well.
Do we have the Bank of Japan as well?
I think so.
We do have the BOJ. God, I never even pay attention to the BOJ, but I need to be paying attention to the BOJ because it is Thursday morning. It'll be after the Fed. So you're right. So yeah, I mean, and you got all these yen pairs, and you got the dollar yen, which is for me. I know you were talking about this a little bit earlier, Dale. You can see the nice little wedge that we've got developing in the dollar yen. I'm short. So what I'd love to see is a bounce back in gold and gold to recover back above 1700. That would actually have this one roll over, but we are developing a wedge, and you have to be respectful of that.
Yeah.
Ahead of the Fed. Now, you guys, like I said, you're all in really. Is Eric here yet? Do you see him? Okay. So I just want to say you guys are in really good shape today because you've got Eric from EPB Macro Macro Research, EPB Macro Research here, and you're going to be able to talk about his expectations of what he thinks the Fed's going to do. Like I said, I met with him last week. That interview just went out, I believe, this morning. We talked about the real estate market, but this is a great opportunity for those of you that have questions on what you think the Fed is going to do. I think this is a great opportunity, especially on a day like today where a lot of people in the UK are taking the day off to mourn the Queen. This is going to be a good day to talk macro for those of us that are here in North America. So Dale, I'm going to pass it over to you. I do want to make mention of this. We are raising our prices here in the next week, and they're going to be raising substantially. So if you want to take advantage of the pricing that we've had for the last several years, this is the time to do it. So take advantage of it, lock in your prices before we raise them this week. So thanks, team, for being here on this Monday. And Dale, have a great interview.
Thank you, guys.
Thank you, Stel, Steve, Blake.
Thanks, guys.
The original crew. So, Eric, welcome back to F.A.C.E. Glad to have you back. It's been a while. And I know that you've been all over YouTube. So unmute and let's talk about what you're seeing on your radar.
All right.
How are you?
Good to be back, Dale. It has been a while. It was nice to catch up with Blake a couple days ago.
Yeah.
It's good to talk to Eric.
Yeah, when we first started doing interviews, I don't think you were as well known as you are now. You've really grown. I mean, your following and footprint.
Yeah, the traction that we've been getting has definitely increased. The YouTube videos have helped with that, and I certainly appreciate you giving me a platform before most people did. So I have a lot of gratitude for you.
Okay, well, we love finding diamonds in the rough, and I know the first time Blake heard you, he wanted to interview you for that site, that Trader Summit, and he said he just interviewed you. So you want to skip the real estate part and we'll get to the elephant in the room, Eric, and that's obviously this Wednesday.
Sure.
Now, if you do want to share your screen. Oh, there we go.
Yeah, I have a couple of slides, but let me see here. Actually, let me try and get this a little bit better here.
So you're showing industrial production, non-farm payroll.
Yeah. So can you see these four slides here?
Yeah.
So what I just wanted to talk about to set the stage before we even talk about the Fed is that it's really important to define where you are in the cycle. There's a lot of debate now. We have 2 negative quarters of GDP. We may have a third negative quarter of GDP. The Atlanta Fed now cast for Q3 is like down to 0.5%. But, real GDP is not an end-all be-all measure. So I just want to take the time to what I feel is officially define where we are, because it can confuse a lot of people. A lot of people right now say, well, we have 2 negative quarters of GDP. We're in a recession. Well, some assets may not be reacting like we're in a recession. What gives? Is this different this time? Right.
Yeah.
And
I'd like to mention that, I interview you, I'd say every 3 months or so. It's kind of how the rotation goes. And you were on top of the story before people were talking about it. Six months ago.
And a lot of that comes from just tracking the cycle in the appropriate way. Now, nothing that I'm about to show in the next couple of slides is a leading indicator. None of that tells us where we're going. But if you can accurately define where we are right now, you have a major leg up over most people. So the cycle is not defined by real GDP, despite what most people think. And this is completely nonpartisan. The cycle is defined by what I call the 4 corners of the economy. But when you look at the NBER and how they date business cycles, real GDP is not a sufficient condition. You have to look at production, employment, consumption, income, all the different parts of the economy, and you can see how all of these are trending. Now, all 4 corners of the economy are trending lower. The growth rate is decelerating, and that's been happening for some time that we've been talking about. But when you combine all of these measures together and you sort of aggregate them to one index, you get a much more reliable indication of where the underlying economy is actually trending. And right now, when you take the composite of income, production, consumption, and employment, we're trending at about 2.5% relative to a long-term average of 1.8, call it 2. So we've slowed considerably, but we're right on trend, basically. And I say that to emphasize the fact that we're not in a recession. We've had 2 negative quarters of GDP, but the reason that asset prices aren't responding that way is because we're definitely not in a recession right now. You can see that clearly. We're trending at about 2% growth. Now, the growth rate is directionally falling, which is extremely important, but it's not negative. It's not, zero. The reason that real GDP was weak or negative in Q1 and Q2 was because of the inventory component. Inventory was substantially negative in Q1 and Q2, and
all the retailers took it on the chin.
Yeah, exactly.
That,
and
right?
There's a measure called real final sales, which just takes GDP and subtracts out inventory. Because if you take the 10-year average of inventory's contributions to GDP, it's 0. So inventory doesn't contribute anything to GDP over the long term, but any given quarter, it could add 2%, it could subtract 2%. It can be extremely volatile. So Q3 of 2021 and Q4 of 2021 were massively overstated because of huge inventory contributions. And then Q1 and Q2 were understated because of these inventory draws.
So Eric, could we have a growth scare without having a recession?
We absolutely could. So we've been trending lower. Now the question, the real $1 trillion question, which ties into the Fed, is can the growth rate in the economy stabilize and sort of start to trend higher without going below 0? And the answer to that is, of course, it can. It's happened many times before. My view this time is that it won't. And I just want to I'll just do it much more quickly this time, but there's 2 other slides I want to show. Is that real GDP is the measure that everyone looks at, but not a lot of people are aware that there's a equal counterpart called real GDI, or gross domestic income. They seek to measure the same thing. GDP tries to measure the expenditure side of the economy. Gross domestic income tries to measure the income side of the economy, and they're supposed to be exactly equal. They're not. It's called a statistical discrepancy, the difference between the 2 of them. But it's common practice to take the average of real GDP and real GDI for a more comprehensive look. And when you do that, similar to the coincident index that I just showed, growth has been trending at 1.9% relative to a long-term average of 2.2. So again, another confirmatory measure that growth has, of course, slowed dramatically from 2021, but it's slowed to basically trend or slightly below trend. And the last one is that everyone's very familiar with the ISM index. It's a very reliable index. They have one for manufacturing and they have one for services. This is not the one that's published by S&P Market. This is the ISM PMI, which is much more reliable. And what do you see here is exactly the same thing. 50 is the expansion contraction line. That would be like 0% growth. The 10-year average is 55.7. And what has happened? We've slowed considerably, and we've slowed to basically just below trend. So all I'm trying to do is paint the picture here is that the economy has slowed considerably.
Right.
And based on the measure that you use, it's either slowed to just a hair above or just a hair below trend. But that's where we are. We're not in a recession. So the $1 trillion question is, where do we go from here?
Yeah, could we turn up here, Eric?
Can we turn up, or do we
so
keep
bearish
going?
Everyone's getting pretty worried about the economy and the Fed.
Right. So to answer that question, we need to use leading indicators, right? We need to use forward-looking measures to tell us where we might be heading, and the Fed obviously guides that path. The Fed is
the economy fight the Fed for a while. And
it can, and it
asset
has.
prices go up, and have not really been able to take the employment rate up, and the market and rates keep going up, and these markets fight it
Mhm.
so that he has to use overkill to finally take down the markets.
Yeah, I think that the expectations embedded in markets are already overkill. And I think that the resilience of the economy thus far, the fact that we haven't already gone into a recession,
Right.
has forced him to go into overkill drive.
Right.
You know, raising rates 400 basis points in 1 year is,
It's
sort
like
of overkill.
chemotherapy, as Steve would say, like chemotherapy.
So,
for the economy.
and the way we can define overkill is sort of embedded in this chart. So it's a little bit convoluted, but what this chart really measures, it's really important. It's a blend of mortgage rates, corporate rates, and treasury rates. So it touches everyone across the economy, no matter where you sit, the household sector, the corporate sector, government expenditures. It's a blend of all of them. And what I do is I take the 18-month rolling change, and it's inverted, so it makes sense with the economic cycle. But when the line is moving lower, interest rates are rising. When the line is moving higher, interest rates are falling. And you can see here, I actually haven't updated this. We actually made a new low. But basically what this chart is saying here is that interest rates across the economy, mortgage, corporates, and treasuries, are 300 basis points higher than they were 18 months ago. That's the largest interest rate spike that the economy's had to deal with since 1980, 1981. And the problem to me, and the reason why this is going in when we look at this in hindsight, a year from now, in my view, is going to be way overkill, is because when you study this chart, and I have another chart that I unfortunately bring in this deck, is that in 1999, interest rates rose about 200 basis points with debt to GDP at 270. Then it was 150 basis points of interest rate pressure at 330% debt to GDP. Then it was 129 basis points of pressure at 340%. And what do you notice here, Dale, is that as the debt levels have increased, it's taken a lower and lower amount of interest rate pressure to trigger a recession. And now we're here with an even larger debt burden, but we're
hasn't yet.
Yeah, and we're going to put 300 basis. Well, we have already put 300 basis points of pressure onto the economy. So the chances that we're able to reaccelerate and avoid a recession is extremely low, in my view, given the fact that you can see the space between the black line and the gray bar. Right, it's a leading indicator. It tells you that when rates spike really hard, 6 to 12 months later, there's going to be a major slowdown in economic activity that necessitates lower interest rates to get the economy out of it. Now we're just pressing interest rates higher and higher and higher. And now we're 300 basis points higher with the highest debt load that we've ever had. In my view, there's going to be a little bit of space here and then another fat gray bar, because it's going to be very difficult for the economy to withstand that kind of rate pressure.
The long bond might be setting up a decent spec buy in this kind of environment.
Hey, Dale. Hey, Eric.
Sure. Hi.
Steve here. How have you been?
Well,
one thing I know you're very well aware of, but you didn't mention in this analysis, is that there is also another huge difference in comparison to the 1980s. The maturity of the debt is extremely shorter than it was back then.
Yeah. So the based on my calculation and everything that I've read, the weighted maturity is, it's tough because when we go into private and public, to get the exact calculation, but it's roughly in the 5 to 7 year range. So what that means is somewhere around 40% of the debt load has to roll every 2 years, basically. So there's two things that factor into the analysis of how deep the recession could be. One is how high interest rates are pressed, and here we're obviously very high. And two is how long they stay elevated, because that will determine how many people have to roll into 300 basis points higher rates. And that's a little bit in question, right? So, if you flash down and flash back up, that could be, you could maybe avoid some of the nastier sides of the recession. But if you press them high, like we have now, and hold them here 6, 12 months, and you have, more and more of the economy has to roll into these higher rates, it's not too hard to see how that would impact things. And where the effect of these interest rates comes first, at least in the private sector, is the housing market. And that's another great leading indicator. So, similar to what I did with the coincident index, I like to put everything into a basket so we don't rely on one indicator. We get really a three-dimensional view of everything that's going on. And this is a basket of, the housing market index, which is a sentiment index of home builders, the MBA purchase applications index, new construction, building permits, new home sales. It's a lot of stuff. And you can see that, we had a tightening cycle in 2017 into 2018. And as soon as the Fed pivoted in December of 2018 is when the housing market bottomed. But the economy continued to slow for another couple of quarters. If you remember, the Fed was cutting interest rates in 2019 before COVID, but the housing market had already bottomed, right? So my point here is that even if the Fed pivoted today, the economy is still going to slow for another couple of quarters because of that lagged effect of the housing market, right?
So with the recession hit us in 2023, I'm getting that, we're back to normal levels on the level you're indicating. Except housing is leading the way. So for Fed policy to work its way through the economy, should we be expecting the recession to become very obvious by the spring of next year?
Yeah. So what I'm tracking in all of my data is that the sharpest parts of the slowdown are going to hit the economy somewhere between October and February of October of this year to February of next year. But you have to remember that a lot of this data is reported on a lag. So that's the window that I believe it's going to hit. But if you just shift that maybe 1 to 2 months forward to account for the data that's reported in that window, it may be something like, November to March or something like that. Because you have to remember what we're trying to capture here. Let me see if I can draw something. Can you see this if I draw something here?
Yeah.
Can you see that? If the cycle moves like this is the economic cycle, you really want to catch, this part. This is the part that causes the real destruction, right? It's when, here it's obvious that the economy is in a deep recession. You got job losses and everything like that. But that's when you want to start to try and think about going the other way. And where we are now is, we've obviously come way off peak and we're right about here, in my view. And the next phase is when we sort of go like this, right? It's very plungy. It's very fast.
Call it what it is, Eric, an economic puke.
Yeah, exactly. And the economic puke is what takes you from, above to below, but it doesn't take you to, March of 2009, right? March of 2009 is when everyone on TV is saying how bad it is. You have job losses everywhere. It's a very scary time. But that's obviously what you're trying to get way ahead of. And what's concerning to me is that the conditions are at right now in place for this bigger economic decline, because, I took this housing index and instead of graphing it as an index, I just tried to graph it as a drawdown, right? And this is, you could sort of see it going back over time. And you can see that every time that the housing market has a pullback, and this is in volumes, not price, has a pullback of about 5%, you almost always get a recession. You didn't get one in 84 and you didn't get one in 94, 95. My last premium report to my subscribers was about a 30-minute presentation outlining why we didn't get a hard landing in 84 and why we didn't get a hard landing in 94. Just to give a sneak preview of why, it's because the housing market bottomed in August of 84. And then the Fed cut interest rates 300 basis points starting in August of 1984. So the day that the housing market, dropped about 5%, you had preemptive monetary easing that cut interest rates, mortgage rates fell 200 basis points, and then the housing market snapped back. In February of 95, the housing market again was down about 5%. but the bond market was already sniffing out the pivot. The mortgage rates peaked in December of 94. And then the Fed paused and started to lower interest rates in early 95. So the two soft landings of the last 50 years basically occurred because at the first sign of housing weakness, which leads the economy, the Fed did a preemptive monetary easing, which caused a very quick rebound in the housing market, a lowering of interest rates, and that kind of allowed the economy to continue chugging forward. And here we have the housing market that's down 9% instead of 5%. And instead of a quick pivot to try and get the housing market going, we're actually
they're loving it. They're loving it. They're successful.
And we want to step on the brakes even harder, right?
Yeah.
So,
well, he emulates Volcker, but the difference between him and Volcker,
no.
did not cause the problem.
Right. Yeah. No, that's a great point. He sort of was.
So
was the
his name should be Bernsker.
Right.
Which is Burns and Volcker combined.
Yeah. So the reason that I believe the chances for a soft landing are so low is because the only time we had a soft landing in the past was when the Fed did preemptive easing at the first sign of housing weakness. Now we have housing weakness that's almost double in magnitude to the two previous soft landings. I mean, everyone in the real estate market can feel it. No, prices haven't, collapsed yet. I understand that, but prices lag volumes. Everyone in the housing market is feels a major slowdown in volumes, and that just ripples through the rest of the economy. And the slowdown in volumes is pretty dramatic. It's enough where it's definitely going to cause a ripple effect through all of the ancillary industries that are connected to real estate and new construction. And we're not looking to stop this. We're looking to amplify it.
What did you think about the statement from FedEx CEO?
It's very much aligned with the view that I'm outlining here, which is the economy is slowing, and the forward-looking indicators are suggesting that we're getting into the nasty phase where it's going to go from slowdown to recession, and I think that window is going to hit us in the next 2 quarters here, and that's sort of what he outlined. He would be on the front lines of this because if the housing market has slowed this dramatically, you think about all the stuff that goes into the housing market. There's a lot of supplies that need to be moved around. There's a lot of, trucking. There's a lot of supply chains. Anyone that's very in tune to, global trade would feel this first. And, FedEx is obviously very sensitive to that. So the real concerning part to me actually is that, it's almost like a recession's already baked into the cake, given how much housing has pulled back. We've never had a situation where we didn't have a recession with the housing market down this much. And given the fact that we're pressing interest rates higher still, there's a chance that this goes down 10, 11, 12%. And now we're getting into levels where we're into the, much nastier kinds of recessions. And look, it's a difficult situation, but that's where
you're like a watchman for a lot of us here on FinTwit, and you talk about worried about the slowdown. What doesn't slow down is your very creative thinking about the economics of the world that we're living in, and the way you share it. And I haven't. You remind me. I think what would be a cool icon for you. Google Tom Terrific. It's a cartoon from, do you know that cartoon?
I don't.
All right, well, Google it anyway. It's a little boy, and he's got a tin hat on. And every time he has an idea, a big puff of smoke comes out of the top. And you're a great thinker when it comes to these things that most of us feel are above our pay grade. So, and you make it understandable, buddy.
Oh, no, I appreciate that. And, we've been doing a lot of work with these YouTube videos to, take all of these concepts that I think are concepts that everyone, intuitively really does understand, but the profession of economics goes out of their way to make it so complicated that nobody can understand it and uses all these big words. And, for example, when talking about the stickiness of wages, right? Everyone just sort of intuitively understands that wages are sticky, but if you read an economics paper, they call it, downward wage rigidity. what does that mean?
Yeah.
Right. It just
Yeah.
kind of, it just
Right.
means sticky wages. Right. So
Yeah.
what we're trying to do with these videos is kind of take all these concepts, break them down into ways that, everyone can understand with some visuals, some animations, some graphics. And at the end of the day, really just provide value to people because, these cycles are so important to track. And, just going back to what I outlined originally, this whole recession, no recession debate, I understand it's super political and, one team needs a recession, one team doesn't need a recession, but we're all trying to make money here. And, we need to understand where we are. And I think that priority number one for everybody should be to have a super clear understanding, unbiased, totally objective of where we are right now, relative to trends, relative to where we were 6 months ago. And then, once you feel like you have that, then you kind of try and make a leap of, okay, is this line going to continue going like this, or are we going to sort of stabilize here and go like this? Because the delta between these two is sort of where the performance and asset prices come in. Some people believe we're doing this and they'll make one bet on assets. Some people believe we're going to make this. Only one team can be proven right. It's not a something that's a welcomed forecast for people. But my view based on leading indicators is that, we're going to do something like that. And that to me, just to give everyone a quick takeaway means that, you should really be erring on the side of defense. It's difficult for me to give a perfect prescription.
It's not return on capital, it's return of capital.
Right. And it's, it's could be a little bit easier now because you got some 1-year paper yielding 1% now, which is like, hey, that's kind of something, right?
Yeah.
When was the last time we had 1-year treasury bill at 4%? So that'll certainly mop up some liquidity.
So be a saver and be aware and prepare. And that's your message, buddy.
Yeah. And one comment I'd like to make, just feel like throw this out there, is a conversation that you guys can kick around because, I think we're running out of time here, or maybe for the next one. I personally believe the Fed's making a mistake here. I think that the problem that we're dealing with is a problem of excess liquidity, right? It wasn't a problem of low interest rates for too long. We had 0% interest rates for 10 years and we didn't have inflation, right? It's really a problem of excess liquidity. So I think the Fed is making a tremendous mistake by hammering interest rates to 4.5%, which is the expectation now. Yeah. And I think they would have been much better served to raise interest rates to something slightly past, what the estimate of neutral is, which most people think is about 2.5%. So I think they would have been better served to raise interest rates quickly to something like 3.25, and then did work on the problem, which was liquidity, by unwinding the balance sheet and focus on that. I think that hammering interest rates to 4.5% when the problem is one of liquidity is something that's just going to cause a massive hit to the economy and not really tackle what the problem is, right? We're going to hammer interest rates to almost 5%. We're going to cause damage everywhere, but there's still going to be this huge mountain of liquidity out there. It's kind of a mess. So I think they would have been better served to raise rates to about 3 and then just sort of really vacuumed out as much of this liquidity as possible.
Or how about this, Eric? They intentionally want to wreck the economy so they could implement the central bank digital currency.
Well, that's certainly a possibility.
I got a little laugh out of you on that.
That's certainly a possibility. I mean,
does it make you nervous that central bank?
Does. Yeah, that does. That does make me very nervous.
All right, see, so that was a nervous laugh.
It was a nervous laugh. Yeah, it was a nervous laugh.
Hey, thank you so much, bro.
All right,
you're the best.
Thanks, Dale. I appreciate it.
Follow Eric at EPB Research. That's the best place. You want to show your website?
Yeah, you could follow me at on Twitter at EPB Research. Let me see if I could show my screen here.
And check out Tom Terrific, buddy.
Tom Terrific.
Tom
so
Terrific.
If you
Google it. Yeah.
There it is. EPBMacroResearch.com. You could go, you could learn, just click this big black button here, it's totally free. It takes you right to my my framework where I kind of dig into details about my whole process. And if you're interested in the research that I publish on a monthly basis, just click that premium service. The basic package is what I provide for people. You get a monthly update. But the framework is a good place for everyone. I kind of just outline the whole process from start to finish. So I greatly appreciate the chance to share it on your show, Dale. Thank you.
We're a fan, Eric.
Thank you.
All right, buddy.
See ya.
So tread lightly. You just heard Eric. Get ready. And I concur. So it doesn't matter what I think, but Eric's smart and appreciate you today, man. So you could join the team in 15 minutes. I'll just reiterate what Blake said. We do great work here, and prices are going up, I think, at the end of this month. So last chance to jump on current rates. Did you hear that, Eric? You better subscribe because our rates are going up.
The time is now. Today's the day.
Today's the day, buddy.
Today's
All right,
the
Eric.
day. Yeah.
Take it easy, man.
All right. See you guys.
All right, bye.
Bye-bye, Rick.
Bye.
Bye, Steve.
Bye, Dale.